The moment the first missile hit, traders in London and New York didn't wait for the news anchor to finish his sentence. They were already buying. Within minutes, oil jumped. Within hours, an entire invisible financial machine had recalibrated itself. And the price at your local gas station was already on its way up. But here's the thing nobody explains. Oil didn't rise because of the bombs. It rose because of a mechanism. A sophisticated, almost invisible pricing system built specifically to absorb the shock of war. Once you understand it, you'll never look at gas prices the same. Let's start with a question that sounds simple, but almost nobody can actually answer. Why does oil go up when there's a war? The obvious answer is supply. War disrupts supply, less oil, higher prices. That makes sense. But the price almost always moves before a single barrel is disrupted, sometimes days or weeks before. When the war starts, prices frequently drop. That's not a glitch. That's the market working exactly as designed. The real answer involves futures contracts, risk premiums, and shipping insurance. These fire like dominoes across a global financial system. To understand where this machine came from, we need to go back to 1973. October 1973. Egypt and Syria launched a surprise attack on Israel on Yom Kippur. The U.S. immediately moves to resupply Israel with military equipment. Within days, the Arab members of OPEC respond with something the world had never seen before. They weaponize oil. The embargo was announced on October 17th. They cut production and banned exports to the U.S. The stable pricing system simply fell apart. Oil prices went from $3 a barrel to nearly $12 in months. That's a 300% increase. Gas lines formed everywhere. The UK banned Sunday driving. The Netherlands limited electricity. In the US, soaring prices and recession produced stagflation. Actual oil removed was only 9% of total supply. The rest was panic and uncertainty. The market was pricing in the unknown. Governments realized the world was dangerously exposed. They needed a mechanism to manage risk. So they built one. In 1975, Congress created the Strategic Petroleum Reserve, massive underground salt caverns along the Gulf Coast, storing over 700 million barrels of crude. The second piece was financial. The NYMEX formalized oil futures trading in the early 1980s, a promise to buy or sell at a fixed price. These contracts allowed everyone, airlines, shipping companies, refiners, to lock in prices months in advance and hedge against the uncertainty of the future. But here's where it gets interesting. Futures markets don't just help businesses plan ahead. They also act as a real-time signal of what the market believes the future looks like. And when war enters the picture, that signal goes haywire in a very specific and revealing way. Under normal conditions, oil futures are in what traders call contango. That means the price of oil for delivery 3 months from now is higher than the price today. It costs money to store oil, to finance it, to insure it. So naturally, future contracts price in those carrying costs. The curve slopes upward into the future. But when a serious geopolitical crisis hits, a war, a blockade, a threat to a key supply route, the curve flips. It goes into backwardation. Suddenly, oil today is worth more than oil next year. Buyers are willing to pay a premium for immediate physical delivery because they're not sure the oil will actually arrive. The panic isn't about what's happening. It's about what might happen. And in a futures market, fear costs money, real, measurable money. This is where the hidden mechanism really comes alive. Because the futures market is only one layer of the machine. Below it sits something even more immediate: shipping insurance. Every single tanker that moves oil across the ocean carries what's called war risk insurance. It's a separate coverage on top of standard marine insurance, and it specifically covers vessels that transit through conflict zones. During peacetime, this insurance is cheap, essentially a rounding error in the economics of oil transport. But the moment a war breaks out, or even credibly threatens to break out, the insurance market moves first, and it moves fast. Think about the Strait of Hormuz, that narrow channel of water between Iran and Oman, about 33 miles wide at its narrowest point. It handles roughly 1/5 of all the oil shipped by sea in the entire world. Every day, somewhere between 16 and 20 million barrels of crude oil passes through that corridor. For context, that's more than the entire daily oil consumption of the United States. When conflict touches that strait, war risk insurers don't wait. Within hours, they begin reassessing coverage. Within days, they start canceling policies entirely. In early March of 2026, when threats triggered marine insurers to announce cancellation of war risk coverage, major firms like Lloyd's of London and Norway's Guard gave 48 hours notice. The policies expired at midnight. Now, here's what that actually means. A very large crude carrier, a VLCC, carries about 2 million barrels. It's one of the largest moving objects ever built by human hands. When war risk insurance vanishes for those ships, the carriers face an almost impossible choice. Transit the strait uninsured, risking cargo worth hundreds of millions, or stop, anchor, and wait. Within days of the cancellations, more than 150 tankers were sitting idle in the Gulf, anchored just outside the strait. The benchmark daily freight rate for a VLCC shot up to $423,000, then to $538,000, then, at the peak of the panic, to nearly $800,000 per day. One single tanker, one single day. Nearly $1 million just to haul oil through a conflict zone. That's not just a number. That's the war risk pricing mechanism in action. Every dollar gets passed on, into the cost of shipping, into the price of a barrel, and ultimately into what you pay at the pump. Now here's the jaw drop moment. All of that is the visible part, the part you read on a financial news website. But underneath all of that is something more precise, more calculated, and honestly, more remarkable. The war risk premium in oil is not just emotion. It is a mathematical probability calculation running continuously, in real time, across hundreds of trading desks around the world. Think of it this way. Traders don't just ask, is there a war? They ask, what is the probability that this conflict disrupts supply, and by how much, for how long? In February 2026, before the U.S. began massing warships in the region, front-month Brent crude futures were trading at around $60 a barrel. Over the following weeks, as tensions escalated, prices climbed to just over $70. That $10 increase, that was the war risk premium, the market's best collective estimate of the expected value of the disruption risk. Here's how the math works. Traders are essentially saying, if there's a 20% chance that a full-scale conflict causes oil to spike by $50 per barrel, then the expected cost of that risk is $10 right now. 20% times 50 equals 10, and the current price should reflect that expected cost. If the probability of escalation goes up, the premium goes up. If the probability comes down, the premium evaporates almost instantly. We saw exactly this dynamic play out when comments from Donald Trump suggested the Iran conflict might be brief. Within hours, oil dropped sharply as traders unwound speculative positions. The war premium collapsed because the probability estimate changed. This is not random. This is not just panic. This is a living, breathing risk model running in real time across the entire global oil market. Now let's talk about what happens when the premium stops being just a number and starts reshaping the real world. When the Strait of Hormuz is effectively closed, even for a week. The consequences cascade in ways that are almost hard to believe. The Middle East doesn't just export crude oil. Roughly 19% of all global LNG shipments pass through Hormuz. When the strait is compromised, LNG tanker rates in the Atlantic Basin tripled within days. Gas prices in Europe and Asia spiked. Power grids that depend on gas started feeling the pressure. Industries that depend on stable energy costs began calculating losses. And then there's the rerouting problem. Ships that can no longer transit the strait have to go the long way, around the Cape of Good Hope. A route that adds weeks to delivery times and thousands of miles to the journey. More fuel burned, more crew time, more carrying costs. All of that gets priced into the cargo. Meanwhile, countries like Japan, South Korea, India, and China face the same sudden arithmetic. They need oil. The normal supply chain just broke, so they bid more aggressively for whatever oil is available through alternative routes. And the people who ultimately feel it are not the traders. They're the drivers. The families heating their homes, the businesses paying fuel surcharges on every delivery, the airlines recalculating ticket prices. Gas prices in the U.S. climbed 58 cents a gallon. Here's where the story gets its modern dimension, because governments aren't passive. They have their own lever, the Strategic Petroleum Reserve. Stored in underground salt caverns in Louisiana and Texas, the U.S. SPR holds hundreds of millions of barrels of crude oil. Created after 1973, specifically designed for moments like this. When a war shock hits, governments can flood the market with supply. The International Energy Agency announced in March 2026 a record-coordinated release of 400 million barrels of emergency oil. The U.S. led the effort with 172 million barrels. It was the largest emergency release in the 50-year history of the organization. But here's the thing that most people don't realize. The SPR release doesn't work primarily by physically solving the supply problem. It works by changing the psychology of the market. The oil from the SPR takes about 13 days to actually reach refineries after a presidential order. And even at maximum drawdown capacity, about 4.4 million barrels per day, it couldn't come close to replacing the 20 million barrels per day that flow through the Strait of Hormuz. The math simply doesn't work. Global oil consumption is around 100 million barrels per day. The 400 million barrel release represents less than 4 days of that disrupted volume. So why do governments do it? Because of how futures markets work. The moment the release is announced, traders recalibrate their probability calculations. The expected severity of the disruption drops. The war premium shrinks. Prices fall. Not because the physical oil has arrived yet, but because the market believes supply is coming and the government has signaled it is serious about managing the crisis. The SPR release is, at its core, a financial intervention disguised as an energy policy. It's the government speaking directly to the futures market. And the futures market listens, at least temporarily. And here's the second twist, the part that even most financial analysts skim past. The SPR release creates an obligation. Every barrel released from strategic reserves has to be bought back eventually. The reserves need to be refilled, and sophisticated traders know this, which means the moment the emergency oil hits the market starts pricing in the future, buying pressure. In some cases, this creates a floor under prices that otherwise might have fallen further. In other words, the same tool governments use to bring prices down contains within it the seeds of a future price support. The market is always 2 moves ahead. And there's another layer. When the Biden administration released 180 million barrels in 2022 to address oil price spikes from the Russia-Ukraine war, the SPR fell to its lowest level in decades. When the Iran crisis hit in 2026, the reserve was already depleted. That means the buffer is thinner. The market knows this. And that knowledge itself becomes a factor in the war risk premium calculation. The less oil in strategic reserves, the more the market prices in the risk of a sustained disruption. The entire machine feeds back on itself. This is not just a war story. This is a story about the architecture of the modern world. Every time you buy gas, every time an airline sets a ticket price, every time a factory calculates its energy budget, all of it is downstream of this mechanism. The futures markets, the insurance markets, the tanker rates, the options traders calculating probability on a Bloomberg terminal at 3 in the morning, the government bureaucrats deciding whether to open the salt caverns in Texas. The 1973 oil embargo didn't just cause a crisis, it forced the world to build a machine for managing the financial consequences of conflict, a machine that now runs continuously, invisibly, beneath the surface of the global economy, pricing in war before it happens, adjusting in real time as events unfold, and transmitting the cost of geopolitical uncertainty to every person on Earth. The bombs and missiles are the visible part of the story, but the money is where the real power lives. And now you know how it works. If you enjoyed the video, click the like button, share the video, and share your thoughts in the comments. And if this kind of deep dive into the financial side of conflict is what you're here for, consider subscribing and turn on the notification. Because this is exactly the kind of story we tell at Conflict Capital. Not just what happened, but why the money moved the way it did. Click the next video for another deep analysis. Thanks for watching.